Do you like risk? Do you not like taking risk? Or are you like, hey, I don't care? A lot of times we get asked a question, especially by mutual fund industry, when they ask you like, hey, what kind of mutual fund I should buy for you? They'll ask you, hey, are you a risk lover? Are you risk averse, meaning you hate risk? Or you're okay, you get the same benefit? And a lot of times we have to make this decision because every decision that we make is under uncertain conditions. So we are in chapter 5. This is part 2 of chapter 5, where as consumers we all are operating under an uncertain environment. We don't know whether the stock market will go up. If I knew that the next 10 years the stock market is going to continuously go up, then I better be a risk lover, because then I'll allocate more of my money into stock markets. But if I know that, hey, the stock market has peaked, the next 10 years is going to be just going down, then I'm better off putting my money in a bond where maybe I'll get more money there. So because there is uncertainty and because everyone is different, I might be a risk lover in a situation, and in that same situation someone else could be not willing to take that risk. And this whole decision making under uncertainty, because we don't know what the future is, it comes down to what is the benefit we will get out of making this decision in a risky way or a non-risky way. So in this part of this video, we're going to learn about this in a very systematic way to find out if you are a risk averse person, you hate taking risk, which is this part, if you are risk loving in that situation, or if you are a risk neutral. But this starts with this concept of utility. Again, we are making decisions in life, and we are making those decisions so that we get something out of it, right? Let's say we stick to this example of whether you should buy a stock mutual fund or a bond mutual fund. And in that, we are trying to optimize internally. What is the benefit I will get out of investing in that stock market, right? And in my mind, I might be bullish about the stock performance, meaning I just saw some trends and I feel that, hey, over the last 10 years it has gone down, so I think it's going to just keep going up over the next 10 years. Let's say that's my view of the world. And so that means my utility or my payoff, the benefit that I will get by investing in the stock market is higher. I'm willing to give away my current income in favor of the future larger income, right? So that's an example. So we think about utility. In any decision, we have to think about utility. Utility is a core concept. These 4 concepts we will go into this video, but utility is the starting point. In any uncertain decision, we always optimize for utility. Utility is basically a measure of a payoff or a benefit. It's an uncertain decision. Now, if I'm going to get a higher utility by being a risk averse person, I'll choose this. But if I get a higher utility by being a risk loving person, then I'll choose this kind of a curve. So there are different kinds of curves which we'll go into. But if I get the same utility, same benefit, same payoff, independent, then I'll be, a risk neutral. So let's get into it. And it all starts with when we have to make decisions under uncertainty, we'll have a frame of mind like, I'm bullish for the stock market, so I expect higher utility, higher payoff. And if we optimize for utility, then, and if we understand utility, then we can understand what kind of a risk preference we have, right? And there's the second concept that builds on utility. It's called expected utility. Expected utility is nothing but the weighted sum of all of the utilities I could get from all kinds of outcomes and their probabilities, right? Because, there is a 10% chance that the stock market can go up 20%, but there is a 90% chance that it can go down by 50%, right? If that's my equation, then I have a utility, to get to one number, I have to calculate expected utility, because there are several outcomes possible. Then what I do is I sum the utilities weighted by their probabilities of all outcomes occurring, right? So that's expected utility. In a sense, it's the one number that will tell you for all the outcomes that are possible in this buying the stock market decision, it could go up by certain percent, it could go down by certain percent, and that's the benefit. You'll get one number. So it's basically utility in an environment where there are several outcomes. So expected utility is one number that tell you this is what you will get out of it, right? Because all of those possibilities could occur. So, and when we understand utility, expected utility, we can get to marginal utility. Let's say, you make, let's use this example to start off, right? We'll understand marginal utility by this example. But there are three types of people. Let's park marginal utility for now, we'll get to it. There are three types of people: risk averse, risk loving, risk neutral. Risk averse is basically I hate risk. I don't like risk, incremental risk. Risk loving is like, yes, I'm willing to take risk because I'll get more utility. And risk neutral is it's the same, right? So there are three types of curves, right? Risk averse curve looks like this. There is a diminishing return over time, but there is an increasing return over time for risk loving. So if you see this, x-axis is income or the return or the benefit or the utility. Y-axis is the utility. X-axis is, let's say, the income, right? Let's say you get the stock market income, and this is the stock market income, x-axis, and y-axis is like, hey, the more income you get, what is the value of payoff? That's the y-axis, right? So now let's go through this and go through these three charts. If you are a risk-averse person, if you make $10,000, let's say 100,000, this is times 10K, so $100,000 if you make, if I make $100,000, which is this 10 unit, then I will get 10 units of utility, right? So $100,000 of income gets me 10 units of utility. But if I'm a risk-averse person, 30,000 income, $300,000 income will only get me 18 utility. So if you see, you go up, you get 18. You don't get 3 times what you got for 10, which is 30. You only get 18, right? So for 100,000 income, you get 10 units. For 300,000, you get 18. So you see, I didn't get 3 times what I got here. I only got 1.8 times. So this curve is diminishing, meaning for every incremental income, the value you got from the previous increment is going to be lower, meaning this increment is going to be lower than this increment. So there is a diminishing returns for a risk-averse person, right? For a risk-loving person, for a 100,000 income, which is this 10 units, I get 3 units. But for 300,000 income, I get 18 units. Look at that. That's like not 3x. That's like 6x, right? So it's like double. So this jump is 6 times, whereas this jump is 1.8 times, right? Huge. Same income. Income goes from 100,000 to 300,000. You get 1.8x jump. Income goes from 100,000 to 300,000. You get 6 times the utility. Now look at this one. 100,000 income, you get 6. 300,000, you get 18. 3 times. So this went 3 times. This went 3 times. So it's like, it doesn't matter. Same, you keep giving more money, I'll keep getting more utility. But here, it went up 3 times. It went up 6 times. Utility went up 6 times. 3x increase in income got you a 6x increase in utility. 3x income increase got you only 1.8x utility. So you see how for a risk-averse person, you give them more money. Let's say you're making 200,000. You're going to give him 300,000. You don't expect it to now all of a sudden have a 100% increase, right? It's going to be very marginal. So this is an important concept. If you feel when you got $200,000 as income and then you got 300,000, if your curve is diminishing, meaning you don't get additional value, then that extra money for you, the money that you made, if it is lower, the additional unit is lower than what this unit got, then you are a risk averse person because you're not getting any utility out of it. But at the same time, let's say you're just starting off and this income is not in hundreds of thousands, tens of thousands. You get $10,000 to $30,000, that's a huge jump. And so you will get this jump. So if this is hundreds of thousands of dollars income, and let's say this was tens of thousands of dollars income, right? Then of course you can expect someone going from $10,000 to $30,000, there's going to be a huge jump because now all of a sudden they can pay the rent. But for someone who's making 100,000, because this units is hundreds of thousands, to 300,000, sure, I could pay my rent before I can pay my rent now. Maybe I can eat at a better restaurant every other week, right? So you see, there is not enough incremental benefit. So that will give you a clear perspective of, if you plot this for yourself, like, hey, I'm taking this risky decision to make this incremental money in stock market, and the benefit I'm getting, if you are able to articulate the utility, or the utility is basically the measure of payoff for the benefit, if it is reducing for you, you really want to check, is it worth it? Spending so much, getting so much more money, but only getting so little utility, right? So in life, you know, it's not that for every decision we are at either always risk loving or risk averse or risk neutral. But if we know the utility that we get out of a decision, then we can categorize ourselves, right? And then we can make right decisions. For example, let's say, and so let's now, before we go to the example of risk premium, I want to cover marginal utility, right? Marginal utility is saying, hey, if I'm making $200,000, if I make just a $2,000 more, which is this much more. So for additional $2,000, which is in this case 22, how much benefit I'm getting, right? It could be that 16 goes to 16.1, right? So that is the marginal. Like if for an increase, a marginal increase in income, what's the marginal return in utility, right? What is the additional satisfaction I got in terms of utility by consuming additional good, right? By making more money, I was able to consume more good. What is the additional satisfaction I got? That's marginal utility, right? And it is a diminishing marginal utility for a risk-averse person. It's an increasing marginal utility for a risk-loving person, and for that decision. And it's the same. It doesn't matter, right? If you go from 10 to 20, 20 to 30, the jump is in equal proportions. So what we just went through, like, 3x increase here, 1.8x. Let's also look at it from like, hey, if you are making the midpoint income, in this case $200,000, to get from $200,000 to $300,000, if you went from $200,000 to $300,000, you get plus 2 points, right? So you go from 16 to 18. But if you, so you just made like $10,000 more, right? You just made $10,000 more. But if you lost $10,000, equal magnitude, right? Look at the loss. The loss is much larger. You will go from 16 units to 10 units. So if you are a risk-averse person, you hate losses. You hate losses. Look at that, because the losses magnitude are bigger for you from where you stand. If the net worth that you have today, if you feel that you're going to lose that $10,000 is going to impact you more than the $10,000 that you will make out of that investment, then you are a risk-averse person. You are a risk-averse person. Because your utility magnitude goes down significantly. 6 points for the same $10,000 loss versus only 2 points for the same $10,000 gain. So remember that. Ask yourself the question, when you're investing that additional incremental money, how much value will you get out of that additional $10,000, the utility, the benefit, the payoff, versus how much losses would you feel? if you feel that those $10,000 not being in your bank account because that stock that you invested in really went down to zero, then there's a problem. Then you are in this risk averse category, right? And you want to take conservative decisions, not aggressive decisions, right? So losses are bigger in magnitude than gain for risk averse. It's opposite for risk loving, or those decisions that have a higher payoff for you. The gain from 20 to 30 is like 10 units, right? 10 units. But the loss is only 5 units. Look at that. And let's say that $10,000, let's say you made, was more critical for you than the 5,000 that you lose. Then that is the time you are risk loving for that decision, and you have a higher probability of winning, or you feel that the stock market, this curve is actually, the payoff is much higher, for me than the downside. Then you want to be risk loving for that decision if you know some of these gains and losses and you can articulate. And risk neutral is the same. You go from 20,000 to 30,000, you get 6 points. Go from 20,000 to 10,000, you get minus 6 points. Same. So if you hate losing the same magnitude of money in that situation for that decision, you are risk averse, and you better take conservative decisions, because your probability is not against, it's against you. It's saying, hey, you will lose more money than you will gain for the same magnitude of gain. But if you have a higher probability of outcomes in your favor, then you better be risk loving for that decision. Yeah. So now we understood 3 different types of preferences that a consumer can have, why it's important to know where you are in that decision, and that will help us understand this new concept called risk premium. Risk premium is the money. We take life insurance, we take car insurance, and we pay premiums, right? Why are we paying money to someone? Because we want to protect our assets, we want to protect the downside, right? Same discussions, right? We are giving away money to protect our downside. Let's say I have $100,000 life insurance and I pay $10 a month premium, just hypothetical example. I'm saying I like to get 100,000 if something were to happen to me, and I'm willing to give $10 every month because I'm certain I'll get 100,000 if something were to happen to me. So that $10, or how much you're willing to pay for that 100,000 cover, how do you calculate that? How does an insurance company calculate how much money are you willing to pay as a premium? That builds on all of this concept, and it builds specifically on a risk averse person, right? Because the definition of a risk premium, let's start with there and we'll break it down, is the maximum amount of money that a risk averse person is willing to pay. Risk averse person is willing to pay to avoid taking the risk, right? If I'm taking a life insurance, maybe I'm afraid there's some issue while I'm driving, and let's say this, I'm afraid of that, so I'm taking life insurance. Let's take an example. And so there's a risk there, and I'm afraid of that risk, and I want to avoid that risk. And what's the benefit I'd get if I were to pay this insurance? I'd get $100,000 if something were to happen to me, right? So if I'm risk-averse person is the right candidate to use, which is this is the money that I'm willing to give away because I want certainty. I want to get certainty of $100,000 in income, right? It's the maximum amount of money that a risk-averse person is willing to pay to avoid taking the risk. So let's build on this, right? Let's say you could make $200,000 income, right? So the utility you get out of it is 16. We saw this, right? And this is a certain decision. Now you are faced with a decision saying, hey, you want to make a decision. Should you make $200,000 income certain, like 100% of the time, or like $100,000 in life insurance certain, just coming up with an example, or would you take $100,000 income 50% of the time and $300,000 income 50% of the time. There's a risk, there's an uncertainty here, right? So you're saying, hey, I'll give you 50% of the time $100,000 income, 50% of the time $300,000 income. Or I'll give you $200,000 100% of the time, right? So if this is a choice someone is facing, or the life insurance example, you will get $100,000 certain if you give me some money, like a premium. And you don't have to worry about this risk of driving on this car where you have a 0.001% accident rate, right? So you're saying, hey, I just want the certainty of money if something would happen. I don't care about this risk. Meaning, I've given that risk to someone else because I'm going to get this certain money, right? So for $200,000 income certainty, the utility you get out of it is 16, right, from this graph. For $100,000, you get 10 units, right? For $300,000, you get 18. If we calculate the expected utility, right, we learned that it would be 0.5 times 10, 0.5 times 18, right? Probability weighted sum of the utility times the probability, right? So what do we get? 14, right? 10 and 18 divided by 2, 14. So we get 14, right? It'll be somewhere here, right? So let's say this is 14. So 14 will come here. Let's take this as $160,000 income. So basically, what you're saying is that, hey, if I were to take this gamble or take this job, which gives me $100,000 for 0.5% of the time, 0.5% of the time, $300,000, it's equal to getting $160,000 of income, which is lower than the $200,000 I would get, right? Because you see, the utility is 14, and that maps to $160,000. But the same utility of 20, right? Because utility of 10 and 18, right? So if you average these two income, 10 and 30, you get 20 average. But for that fixed income, you get 16. But we just saw that if you calculated from the utility standpoint, expected utility is lower. And that makes sense because you're taking a risk. You shouldn't get 16 that you get from a fixed income. You should get utility lower. And that means you are willing to pay, for you, the difference between these two, right? A fixed income, $200,000 and $160,000 is the premium that you're willing to pay. Because this is a certain income. $16,000 certain income gives you the same expected utility of 14 as a gamble that $10,000, $100,000 with 0.5 probability, $300,000 with 0.5 probability also gives you 14. So you are saying, I'm willing, just give me the $16,000 income, meaning you are willing to give up this difference of close to $40,000, right? 200,000 minus 160,000. So you see this, or this curve here, right? A, B, right? Or this difference is the risk premium. What you would have gotten without the gamble, 200,000, and what you got with the gamble, assuming the fixed payoff that you would get with 160. So whatever that difference is the risk premium. Because you're saying, hey, I want the insurance company to take the risk. I'll give them $40,000. They'll do something with it. But at least I'll get the benefit of making $160,000, which is fixed. And I don't have to take this gamble of 10,000, 50%, 30,000, 50%, 110,000, 50%. So that's the risk premium. So hopefully you understood a little bit about how should you calculate whether you're risk averse for a given situation, risk loving or risk neutral, and then how much money should you be willing to pay to an insurance company for a premium, assuming certain fixed outcome and certain probabilistic outcome. If you can do that, you can actually see for yourself, is it worth paying the insurance premium that you pay, the risk premium that you pay to the insurance company. So this is very practical, requires you to introspect and come up with some of these hard utility numbers, and that will require a lot of self-awareness. You have to know, like, hey, what is the real benefit I'm getting out of this additional? Once you do this, you can easily crack the nut of how much risk premium to pay to an insurance company. Should you aggressively buy into stock markets at certain points? Should you not buy into stock markets? And it helps us understand different types of risks, right? And so in the next section, the third part, we'll learn about reducing risk. Thanks.